Imagine you are drowning in debt. Not a little debt, the kind that keeps you awake at 3 a.m. The kind where you've borrowed from every friend, maxed every card, and the minimum payments alone are eating your salary. So you do the only thing that makes sense. You borrow more. Not to spend. Just to survive. Just to make it to next month. And here's the thing. It works. The pain stops. The pressure lifts. For a moment, you can breathe again. Now, imagine that moment lasts a decade. Now imagine that the entity doing this isn't you, it's the most powerful government in human history. And the borrowing isn't borrowing at all, it's creation. Money, conjured from nothing, injected into an economy of 8 billion people. Here's the question nobody in power wants you to ask. What happens when the medicine becomes the disease? This isn't really about money printing. I know that's what the title says. I know that's what the charts show. But when you trace this system back to its roots, past the Federal Reserve, past Bretton Woods, past Keynes, you find something far more unsettling. You find a trap. One that was engineered with good intentions. One that every modern democracy walked into willingly, and one that, by design, has no clean exit. This is a story about political incentives. About what happens when the tool that saves an economy also makes every future crisis more expensive to solve. About the moment a government crosses a line it didn't know existed, and can never cross back. And it is happening right now, at scale, in every major economy on Earth. Put yourself in the chair of a finance minister. It's 2008. Markets are collapsing. Unemployment is spiking by the week. Your phone is ringing with calls from bank CEOs who are hours from insolvency. Regular people are losing their homes. You have two options. Option 1, let it burn. Allow the market to correct. Accept the recession. Endure 2, maybe 3 years of genuine economic pain. Rising unemployment, contracting GDP, political chaos. But emerge on the other side with the system reset and the debt cleared. Option 2, intervene, print, inject liquidity, backstop the banks, cushion the fall, keep unemployment from exploding, win the next election, and deal with the long-term consequences later. Every rational political actor chooses option 2, every single time. Not because they are corrupt, not because they are stupid, because the short-term cost of option 1 is visible, immediate, and politically fatal. The long-term cost of option 2 is abstract, delayed, and someone else's problem. This is the first layer of the trap. It isn't ideological, it's structural. The incentive to print isn't a conspiracy. It's just democracy working exactly as designed. The Steelman argument for stimulus is compelling. It goes like this. In a crisis, private demand collapses. People stop spending. Businesses stop investing. The economy spirals. Government is the only entity large enough to fill that void. And if it acts decisively, it can prevent a minor recession from becoming a catastrophe. The 1930s prove what happens when you don't intervene. The 2008 response proved you can. This argument is not wrong, it is incomplete. Because what it leaves out is what economists call the ratchet effect. Stimulus doesn't just fill a gap, it restructures the economy around the assumption that the gap will always be filled. After the 2008 bailouts, global interest rates were cut to near zero. Companies borrowed cheap money to buy back their own stock. Asset prices inflated. Wealth concentrated at the top. And an entire generation of investors learned a single powerful lesson. The central bank will not let markets fall. They called it the Fed put. The implicit guarantee that if things got bad enough, intervention would arrive. And when COVID hit in 2020, governments didn't hesitate. They didn't even debate. Within weeks, the United States alone injected over $5 trillion into the economy. The EU launched its own historic stimulus package. Central banks globally expanded their balance sheets by more than $8 trillion in under a year. It worked. Markets recovered faster than anyone expected. GDP bounced back. Unemployment fell. And now the economy needed even more stimulus just to maintain the same level of activity. The dose required to produce the same effect keeps rising. That's not recovery, that's dependency. But that's not the real problem. Here's a number worth sitting with. Global debt, public and private, crossed $105 trillion in 2023. That is roughly 110% of global GDP. The entire planet produces less in a year than it owes. Now consider interest rates. For 40 years, rates trended downward. Debt was cheap. Governments borrowed freely. And the whole system was quietly predicated on one assumption: rates would stay low forever. When inflation forced central banks to raise rates in 2022 and 2023, something quiet and catastrophic began happening. The cost of servicing existing debt exploded. The United States, for the first time in decades, was spending more on interest payments than on its entire defense budget. not the principal, just the interest. The structural trap is now fully visible. If governments stop stimulating, if they raise rates, cut spending, reduce deficits, the debt service burden becomes crushing. Growth slows. Social programs contract. Political instability rises. If they continue, if they keep rates low, keep spending, keep expanding the money supply, inflation eats real wages. Asset prices diverge from economic reality. The gap between the financial economy and the productive economy widens until one of them breaks. There is no comfortable path. There is only the choice of which pain to delay. And we haven't even talked about what this does to the countries that don't have the luxury of printing the world's reserve currency. When the United States prints dollars, it exports inflation. The dollar is the global reserve currency. Commodities are priced in dollars. International debt is denominated in dollars. When the Fed expands its balance sheet, those dollars flow outward into global financial markets, inflating assets in New York, London, and Singapore, but also driving up the cost of food, fuel, and imports in countries that had no vote in the decision and no tool to respond. In 2021 and 22, as U.S. stimulus money flooded global markets and supply chains fractured, food prices in sub-Saharan Africa surged by 30 to 40%. Sri Lanka collapsed. Pakistan went to the IMF. Lebanon's currency lost over 90% of its value. These weren't random events. They were the spillover effects of a monetary system designed to serve the issuer of the reserve currency and to distribute the costs everywhere else. China, Russia, Brazil, India, South Africa, the BRICS bloc, are not building an alternative reserve currency because they hate the dollar. They are building it because they understand that dollar dependency is a structural vulnerability and that every round of U.S. stimulus is an argument for why that vulnerability needs to be addressed. The stimulus addiction isn't just a fiscal problem. It is accelerating the fragmentation of the global monetary order. And it gets worse. Governments that print money don't just do it out of desperation. Over time, they begin to do it strategically. Stimulus becomes a tool of political consolidation, a way to build constituencies, reward allies, and outcompete rivals without raising taxes. Since 2000, the U.S. national debt has increased by more than $25 trillion. Across that same period, the top 1% of wealth holders in the United States saw their share of national wealth increase from roughly 30% to nearly 40%. The money was created, it did not reach evenly. It flowed through the financial system, where asset prices are the transmission mechanism and concentrated at the top. Meanwhile, inflation eroded the real wages and savings of the middle class. You think quantitative easing is a neutral technical tool. It is not. It is a redistribution mechanism. And the direction of redistribution has been remarkably consistent across 40 years and multiple administrations of both parties. Governments don't just become addicted to stimulus because it's convenient. They become addicted because for certain constituencies, it is not a crisis, it is a feature. Every round of stimulus makes the next crisis more expensive to solve. Each intervention raises the floor. After 2008, the floor for intervention was a financial sector collapse. After 2020, the floor fell to any significant economic disruption. The threshold of pain that triggers a policy response has steadily declined, while the size of the response required to achieve the same stabilizing effect has steadily increased. This is a classic feedback loop. The system is not self-correcting. It is self-reinforcing. When central banks expand their balance sheets, they absorb government debt, effectively monetizing the deficit. This allows governments to spend beyond their tax revenues without immediately triggering a market penalty. The bond market, which used to act as a disciplining mechanism, raising the cost of borrowing for fiscally irresponsible governments, has been partially neutralized as a check on spending. The term for this is financial repression, and it has been the quiet operating system of most major economies since 2010. Financial repression means savers are punished. Real returns on deposits are negative when adjusted for inflation. Capital is pushed into riskier assets, equities, real estate, speculative instruments, not because investors want more risk, but because the safe options have been engineered to lose value in real terms. This is how ordinary people end up exposed to asset market volatility without ever choosing to be investors. The system requires their participation. It extracts their risk tolerance without their full understanding of what is being done. The final layer is not about money. It is about trust. Every currency is, at its foundation, a social contract. A collective agreement that these pieces of paper, or these digital entries in a ledger, represent real value and can be exchanged for real things. That contract is maintained by confidence, and confidence, once broken, does not return quietly. History offers a small number of catastrophic examples of what happens when that confidence fails. Weimar Germany, Zimbabwe, Venezuela. Argentina's repeated cycles. In each case, the mechanics were different. The outcome was the same. When people stopped believing that the currency would hold its value, they stopped holding the currency. And when enough people did that simultaneously, the entire system unraveled with a speed that shocked even those who had predicted it. The question is not whether this will happen to the dollar, the euro, the pound. The question is whether the conditions that produce such breaks are being slowly assembled piece by piece across the decisions of the last 20 years. There is one piece that almost nobody is discussing openly: the global debt-to-GDP ratio, the trajectory of central bank balance sheets, the erosion of real yields, the acceleration of de-dollarization. These are not independent events. They are symptoms of the same underlying process, a global financial system that has been running on stimulus so long that it may have permanently altered what a stable baseline even looks like. We may no longer know what the economy looks like without the drug, because nobody alive in a position of power has governed without it. If you think this system is stable, if you think the cycle of stimulus, inflation, repricing, and re-stimulation can continue indefinitely, there is one variable the models have not fully priced in: political tolerance. Every round of stimulus that inflates assets while eroding wages produces a more economically divided society. Every crisis that is solved by printing produces a population that is slightly more aware that the solution has costs they are bearing invisibly. And at some point, that awareness crosses a threshold. We have already seen the early signal. The political volatility of the last decade, across Europe, across the Americas, across Asia, is not random. It is the downstream effect of an economic model that has been delivering growth statistics that do not match lived experience. People have been told the economy is recovering while their purchasing power is declining. They have been shown unemployment figures while feeling economically insecure. And slowly, they have stopped trusting the institutions that run these models. This is not a small problem. Democratic legitimacy requires that citizens believe the system is, at minimum, not structurally rigged against them. When that belief erodes, not through conspiracy, but through experience, the political consequences are unpredictable in their form, but entirely predictable in their direction. The stimulus addiction is not just an economic trap, it is a slow-moving political crisis. And the next chapter of this story is already being written, in the design of central bank digital currencies, in the restructuring of global reserve arrangements, and in the fiscal stress tests that several major economies are quietly approaching. If you want to understand what happens when this system reaches its next inflection point, when the debt ceiling becomes structurally unfixable, when a reserve currency faces its first serious sovereign crisis in the modern era, that is a story worth telling separately, because what comes next is not a continuation of the current system. It is something new, and the people designing it are not waiting for your permission.